Absolutely.
Here's a comprehensive and deeply detailed stock market vocabulary list. This will cover basic to advanced terms and their deeper meanings, with thorough explanations, examples, and how they are used in the world of investing and trading. Stock market fundamentals. Stock, share. Definition: a unit of ownership in a company that entitles the holder to a portion of the company's profits, via dividends, and voting rights, in some cases. Stocks represent the equity or ownership in a company. Example, if you buy one share of Apple Inc., AAPL, you own a small portion of Apple. Equity definition: the ownership interest in a corporation represented by its outstanding shares of stock. For individual investors, equity represents the value of their ownership in the company. Example, owning shares of stock in a company is a form of equity ownership. Market capitalization, market cap. Definition: the total value of all a company's outstanding shares of stock, calculated by multiplying the stock's current price by the number of outstanding shares. Formula: market cap equals share price x outstanding shares. Example, if a company has 100 million shares outstanding and the share price is $50, the market cap would be $5 billion. Dividend definition: a payment made by a company to its shareholders, typically in cash or additional shares from its profits. Dividends are usually paid quarterly. Example, Coca-Cola pays a dividend of around 164 Oz per share each year, paid quarterly. Capital gains definition: the profit from selling a stock or other investment at a higher price than the original purchase price. Example, if you buy a stock for $100 and sell it for $150, your capital gain is $50. Market types and conditions. Bull market definition: a market in which the prices of securities are rising or are expected to rise. It is characterized by widespread optimism, increased investor confidence, and the expectation that strong results will continue. Example, the 2010-2020 bull market in the US saw consistent growth in stock indices like the S&P 500. Bear market definition: a market in which the prices of securities are falling or are expected to fall. A bear market is typically marked by a decline of 20% or more from recent highs. Example, the 2008 financial crisis caused the stock market to enter a bear market, with many stocks losing over 30% of their value. Correction definition: a short-term decline in the price of a stock or market index of at least 10%, but less than 20%. 1. Corrections are typically seen as healthy market adjustments. 2. Example, after a prolonged bull market, a market correction might occur where prices drop by 10% before rebounding. Recession. 1. Definition: a period of economic decline, typically defined as 2 consecutive quarters of negative GDP growth, rising unemployment, and reduced consumer spending. 1. Recessions often lead to stock market downturns. 2. Example, the 2008 recession caused a global economic downturn, affecting stock prices worldwide. 3. Stock valuation metrics. Price to earnings, PE ratio. 1. Definition: a ratio for valuing a company, calculated by dividing the current share price by its earnings per share, EPS. 1. It indicates how much investors are willing to pay for $1 of earnings. 2. Formula: PE ratio = share price, earnings per share. 3. Example, if a stock's price is $50 and the EPS is $5, the PE ratio is 10, meaning investors are willing to pay $10 for every $1 of earnings. Earnings per share, EPS. Definition: a company's profit divided by the number of outstanding shares. It's a key indicator of a company's profitability. Formula: EPS equal net income. Shares outstanding. Example. If a company earns $10 million and has 1 million shares outstanding, the EPS is $10 per share. Price to book, PB ratio. Definition: a ratio that compares the market value of a company's stock to its book value, the value of its assets minus its liabilities. 1. A lower PB ratio suggests that a stock is undervalued. 2. Formula: PB ratio equals share price, book value per share. 1. Example: a PB ratio of 1 means the stock is trading at its book value. 1. If it's less than 1, the stock may be undervalued. Price to sales, PS, ratio. Definition: a ratio that compares a company's stock price to its revenues, helping investors understand how much they are paying for each dollar of sales. Formula: PS, ratio equal share price, revenue per share. Example: if a company has a revenue of 1 billion and 100 million shares, the PS ratio is calculated by dividing the market cap by the revenue per share. Dividend yield. Definition: the annual dividend income divided by the stock's price. It indicates how much income an investor can expect to earn from dividends relative to the price of the stock. Formula: dividend yield equal an annual dividend on share price. 2. Example: if a stock pays $5 in dividends per share and the stock price is $100, the dividend yield is 5%. 4. Investment strategies. Growth investing. 1. Definition: an investment strategy focused on companies that are expected to grow at an above-average rate compared to others in the market. 1. Growth investors typically look for stocks that reinvest profits to expand. Example: Tesla is a typical growth stock, with investors expecting the company to rapidly grow in the electric vehicle industry. Value investing. Definition: a strategy that involves identifying undervalued stocks based on their fundamentals, e.g., PE ratio, PB ratio. Investors buy these stocks hoping that the market will eventually recognize their true value. Example: Warren Buffett is a famous value investor who looks for stocks trading for less than their intrinsic value. Dividend investing. Definition: a strategy focused on buying stocks that provide regular dividend payments, making it ideal for income-seeking investors. Dividend investors prefer companies that consistently pay dividends. Example: Procter & Gamble is known for its reliable and growing dividend payments, making it popular among dividend investors. Index fund investing. Definition: investing in a fund that tracks a broad market index like the S&P 500. Index funds are passively managed, and they seek to replicate the performance of the index. Example: Vanguard S&P 500 ETF, VOO, is an index fund that tracks the performance of the S&P 500. Dollar cost averaging, DCA. Definition: a strategy where an investor invests a fixed amount of money at regular intervals, regardless of market conditions. This helps mitigate the risks of market volatility and timing the market. Example: you decide to invest $500 in a stock every month, no matter whether the stock price is high or low. Advanced terms, margin trading. Definition: borrowing funds from a broker to trade stocks, allowing an investor to purchase more stock than they could with their own money. This increases both potential profits and losses. Example: if an investor has $10,000 but borrows an additional $10,000 from a broker, they can trade with $20,000, but they must repay the borrowed amount with interest. Short selling, shorting. Definition: selling a stock you don't own, hoping to buy it back at a lower price to profit from the price decline. Short selling is a high-risk strategy because losses are potentially unlimited. Example, you short sell 100 shares of XYZ Corp. at $50 per share, hoping the stock price will fall. If the price falls to $40, you can buy the stock back and make a profit of $10 per share. Options. Call and put options. Definition. Financial instruments that give investors the right, but not the obligation, to buy. Call option or sell. Put option. An asset at a predetermined price before a specific expiration date. Call option. A bet that the price of the stock will rise. Put option. A bet that the price of the stock will fall. Example, you buy a call option for Apple at a strike price of $150, expiring in 1 month. If the stock price rises above $150, you can exercise the option to buy it at $150 and sell it at the market price for a profit. Hedge fund definition. A pooled investment fund that uses a variety of strategies, including leverage, short selling, and derivatives, to generate high returns. 1. Hedge funds typically require high minimum investments and are open only to accredited investors. 1. Example. Bridgewater Associates is one of the largest and most well-known hedge funds in the world. Liquidity. 1. Definition. The ability to buy or sell an asset quickly and without affecting its price significantly. 1. Highly liquid stocks are easy to trade, while illiquid assets may be harder to sell. Example. Stocks of large companies like Apple and Microsoft are highly liquid because they are traded frequently, whereas smaller companies may be less liquid. Beta definition. A measure of a stock's volatility in relation to the market. A beta of 1 indicates that the stock moves in line with the market, while a beta greater than 1 indicates higher volatility. 1. Example. A stock with a beta of 1.2 is expected to be 20% more volatile than the market. 6. Risk management and trading tools. Stop-loss order. 1. Definition. An order placed to automatically sell a stock when it reaches a specific price, helping limit potential losses. Example. You buy a stock at $100 and place a stop-loss order at $90. If the stock price falls to $90, your stock will automatically be sold. Trailing stop definition. A stop-loss order that moves with the stock price. If the stock rises, the stop-loss level rises as well, locking in profits. Example. If you buy a stock at $50 and set a trailing stop of 10%, your stop loss will automatically rise to $55 if the stock price goes to $55, and you will sell if the price falls back below $55. Don't forget to turn on notifications so you never miss a lesson. Let's get started and make your stock market investment or trading preparation a success.